Hi, I'm back. This is my second lecture on Chapter 9. When we left off the other day, let's see where we were. We were talking about the preparation of a manufacturing budget. By the way, manufacturing budgets are I'll say the most complicated of the three major types of business, the others being service and retail. Manufacturing tends to be a little more complicated, but that doesn't make it hard. Okay, it simply means that you have to be systematic and you have to do a bottom-up approach involving many different areas, different strata of your organization to make sure that you've borrowed on the talents of all of the key people, key inputs, people from sales, manufacturing, research, accounting, general management, HR, and such, okay? We started with the sales budget. We saw that it was very easy to determine the sales budget as far as designing a spreadsheet, especially in a single product company such as we have here. Obviously, in a larger conglomerate, even in the business I started, it was much more complicated, and yet, if you're systematic about it, it is not difficult. And the presence of an Excel spreadsheet for a relatively small, moderately sized company is something you can easily do. That's how my company was born, in fact, on an Excel spreadsheet. So now that you've determined what your salespeople are going to sell, and now I want to emphasize, sales gave us both units and dollars. Okay, now this is a production budget. We'll talk about dollars later, but for now I'm only focused on units. These are all denominated in units, in this case pounds of raw chocolate that we produce for candy makers. So we know on the top line by quarter and for the total year what our salespeople will sell. I told you in the previous lecture that we're going to add some desired ending finished goods inventory to that because we always want to have a little something in the warehouse for that unexpected call from the purchasing agent of a customer's site. Okay, so even though in quarter one we're going to sell 195,000 pounds of chocolate, we want to keep an extra around, an extra 21,600, an extra amount. And management has chosen that number. Management has said in their infinite wisdom, we want to take next quarter's sales and we want to have at least 8% of that sitting in the warehouse on the last day of the quarter. So I need 216,000, not just the amount that the salespeople will sell. Okay, now let's stick with the concept of inventory. We have to presuppose that we ended the previous year, 2012, right, with the same requirement in mind. Management said we want to take the first quarter of 2013, their projection, and we want 8% of that. So we can assume that on January 1st of this year, we already had some in our warehouse. Well, listen, if you already have it, you don't have to make it, right? So even though we think initially we'll have to make 216,000 pounds, we already have 16,000 sitting in the warehouse. So I'm going to deduct it. Any beginning finished goods inventory that we have, we deduct. So we only have to make, in the first quarter, 200,600 pounds. Okay? Now, ending finished goods inventory, every single month, we're going to have 8% of next quarter's expectation. Okay? And someone's going to have to forecast what the first quarter of 2014 is going to be as far as sales, so we can come up with that 17,600, okay? Sometimes you'll be given that number, other times you'll calculate it based on next year. The point is that is how much we want on the last day of this year in our finished goods warehouse, okay? So you'll notice that every single quarter, okay, that quarter's ending inventory, last day of quarter one, is obviously going to become the beginning inventory of the succeeding quarter, quarter two, except this time I want to deduct it. So you'll notice how the 29.4 at the end of quarter two is deducted in quarter three because we already have it at the start, okay? Notice something else, friends. The last day of quarter four, that's December 31st of 2013. Now, you can't just add this line across to get the total year, can you? No, why? Because inventory is a balance. It's not additive like sales are. Sales, you just add these four numbers across and you get 1,082,000. All right, December 31st, you've got 17,006. The last day of the quarter four is also the last day of the year, so you just carry that number right over. The math will work, okay? The same deal works with the beginning inventory. You don't add that line up. Whatever you had on the first day of quarter one, let's call it January 1st, is also the first day of the total year, January 1st. So just carry that 16,000 over to here. And remember, I like to put them in red and as negatives to remind myself to deduct. Because even after 40-something years in business, yes, ladies and gentlemen, true confessions, I do make math errors. So you want to make sure that you remind yourself of the dynamics of a spreadsheet, no matter how simple it seems to be. So, hold on. Pardon my rudeness there. Okay, but my voice will die if I don't drink something. Total units to be manufactured, therefore, I need 216,600. I've already got 16,000 of them from my beginning inventory. So in the first quarter, I only have to make 200,600 pounds of chocolate. For the whole year, I need to make, my manufacturing person, she's going to need to know these numbers. These will represent her goal, that she's going to make 1,083,600 pounds of chocolate. That's how a production budget works. Again, from the start to the finish, this entire production budget is in units, not in dollars. How do you dollarize it? Well, you know what you're going to have to make, and you remember from manufacturing accounting, managerial accounting, as we call it here at Dean, ACCT 200 it is, that we have to dollarize what we manufacture with three components. Those three components, here's a blast from the past, are direct materials, direct labor, and manufacturing overhead. In essence, every single expense of your manufacturing facility, excluding top management and your sales staff. We enumerate those separately as what we refer to in Accounting 200 as period costs. Okay? In other words, we don't put them into inventory. Direct materials, direct labor, and manufacturing overhead do go into inventory as we make it. Okay? So in this next couple of pages, in the book, page 239, 240, 241, I tell you what it takes to make our chocolate. I kept it simple, 2 ingredients, raw cocoa and sugar. Okay, and I give you the component percentages or proportions, I should say here. Okay, we need 0.8 pounds of raw cocoa in every pound of chocolate and 0.2 pounds of sugar. So the math, multiplicative, it's all simple. Okay? So in this case, the first quarter's production, we found out in our production budget, remember all of these tie together, okay, that we're going to have to make 200,600. Okay? I want to remind you of something else. I want to remind you that we had to deal with inventory a moment ago, finished goods inventory when we did our production budget. Now when you're doing your direct materials budget, direct materials is unique as a manufacturing cost in that it includes inventory. You already had some raw materials at the start of the quarter, and you want to end the quarter with some raw materials as well. So on the first day of the following period, you walk in, you can start producing right away without waiting for the cocoa to arrive. Okay? All right, very good. So I'm just going to pause for one moment here because my phone is buzzing. So give me 1 second, please. I'll be right back, friends. Okay, I'm back. Sorry for the interruption. Okay, so please read these next couple of pages and you'll see my calculations, my assumptions, but you're going to see that I've prepared 2 budgets for direct materials. Why? Because there are 2 ingredients. Okay, 2 inventory items. Now, watch how this thing is constructed, friends. The dynamics are very simple to what we just did in the production budget, except we're going to start with the number of units of finished goods. Then we're going to say, given that, how much of my direct materials, my raw materials for each raw material, do I need to make that amount of finished goods? And then thirdly, I'm going to dollarize it. So this budget is going to contain, it's going to start with units of finished goods output. It's going to then go to the raw materials that I have to input. And then at the end, I'm going to cost it out. So we've got 3 different units of measurement in this budget. Let's just focus on cocoa and forget about the sugar because the sugar is the same thing, just a different proportion. You'll notice I start with units to be manufactured. Where do I get it? I get it right from my production budget that I just did. Please remember, we're doing budgets now, not a plan. The budgets are the bedrock of the plan. Everything in the overall plan is based on the bedrock of these numbers, the budgets. Okay, so now, knowing that I have to make this amount of chocolate when I'm done, and I know that 0.8 pounds of cocoa are needed for each pound of output, refined chocolate, I'm going to need cocoa, let me not call it chocolate. I need raw cocoa of, in the first quarter, for example, 160,500 pounds. 0.8 pounds times 200,000, 0.6 pounds of output. Okay? Management has given me a rule that we want to have some ending inventory of cocoa as well, so I need to go buy that. I'm trying to figure out how much I'm going to buy this raw material, this cocoa. How much am I going to buy? Okay? So the total pounds of cocoa I need, by addition, are in the first quarter 182,700. Once again, because I do have cocoa already on the first day of the year, and I will at the start of every quarter, I want to deduct it because I don't want my purchasing agent to go out and buy it again if I've already got it. I already have. Of the 182,700 pounds of raw cocoa I need, I already have 16,000 pounds sitting in the warehouse. I'm going to therefore deduct it, and that means that my purchasing agent in the first quarter will have to plan on buying 166,600 pounds of cocoa. All right. That's a goal. That's a goal for her to follow. We don't want to start stacking up inventory, so look in the second quarter, we're going to need more. We want to make sure that she only buys as much as we need. We don't want too much inventory lying around. Number one, I assume raw cocoa is perishable, but secondly, it would be tying up our cash, as I've described to you in preceding lectures. That's how inventory can cripple a company if we don't control it. I'm then going to multiply the cocoa by the rule I gave you up above. All right, the cost of cocoa bean paste, raw cocoa, will stay steady at $2 a pound. So I multiply the 166,600 pounds that I have to buy by $2. Now I've given my purchasing agent a second goal. Number one, when she has to buy those pounds of cocoa. Number two, how much she's allowed to pay for it. Sound familiar? We dealt with this in manufacturing accounting, ACCT 200. So we've given her a unit goal, pounds of cocoa, and a dollar goal. The cost, therefore, in the first quarter is $333,200. The direct materials budget for cocoa is done. I did exactly the same thing for sugar. Okay? The math is all the same. The sugar per pound of output is 0.2 pounds, so the weight's a little different, and the inventory is a little different, but the rationale, the dollarization, is all the same. You'll notice I'm holding the cost of cocoa to $2. There it is. And the cost of sugar to $2.50. In real life, that might fluctuate. It might go up for inflation or a variety of other reasons. It might come down because as our volumes purchased go up, we might get a price break. All of these dynamics must be analyzed by the purchasing people as they are preparing their budget. Remember, you want input from all of the experts who will then use this budget as a barometer of their performance in the coming year. Okay, so this manufacturing cost profile, we've seen something like it before. We called it a job order cost card. We called it a bunch of other things in managerial accounting. But in this profile, it says this is a blueprint of what it costs us to make 1 pound of our output, 1 unit of output, 1 pound of chocolate in this case. We've defined our direct materials. Okay? So we know how many units that we are going to make. We know how much the material cost is. So therefore, to make 1 pound of chocolate, simple math will tell you that it takes us $2.10. Okay? We don't know what the direct labor and factory overhead is yet. Okay, but we'll get to that. All right, so as I note in my book, this is like a master profile, this manufacturing cost profile. That's something that all our manufacturing people and management walk around with in their heads as a guideline about their performance. Okay. Next, a direct labor budget. I've kept things very, very easy. We need to know two things, friends. Okay, we need to know how many hours it takes us to make a unit of output. And secondly, we need to know how much we pay our people for direct labor, in this case per hour. Okay? Now, we already know how many units we're manufacturing. That number feeds in directly from our production budget. So we carry that same number in here. Okay, I have done an efficiency study. I sent someone out on the shop floor with a stopwatch to measure my people and see on average how long it takes, including inefficiencies, downtime, breaks, and things like that, to make 1 pound of chocolate, and it seems to average 0.033 hours. I'm measuring this in hours. Why? Because I'm going to use an hourly wage in a moment. All right, so the number of direct labor hours that I need to make the amount of chocolate I intend to make, and again, this is measured in thousands, so it would be 6,600 hours of direct labor in the first quarter. All right. My payroll manager says, I think the average cost of a direct labor person next year is going to be 15 bucks. Let's use it. Okay, very good. Now we've given him a goal too. Manufacturing has been given a goal of several goals already, but they know they have to hold their direct labor to a certain number of hours, and we'll measure their performance based upon that. Personnel or human resources also knows that we're holding them to a standard of $15 when they do their hiring. Okay, so we're goal setting here for evaluating the performance of these people. So by multiplication, we now know our direct labor cost in the first quarter. It's $99,300. The direct labor budget is fairly simple. Remember, it gets more complicated if you start introducing things like various degrees of direct labor or union negotiations. Overtime, that's a good one as well, because if all of a sudden, for the number of people we have to stop paying a time and a half premium for overtime hours worked by law, we would have to factor that in as well. Okay? But this is a nice, simple example. And now we have the second element in our manufacturing cost card, given the number of pounds we expect to make and the total direct labor cost of 0.033 direct labor hours at 15 bucks an hour, we know that we can plan on 1 pound of chocolate containing 50 cents worth of labor content. Okay. Finally, we get to the factory overhead budget. We call this jokingly the garbage can account because it's every other factory expense that you have except direct material and direct labor, which were just accounted for separately. So this is the everything else account. We also know that these costs experience two types of behavior, okay? They are variable or they are fixed. In other words, a variable cost changes with production volume. A fixed cost stays the same, okay? A variable example might be, let's say indirect materials. If you're not making anything, you're not going to consume any indirect materials. If you're making a lot of stuff, you'll consume a lot of indirect materials rather. So that's a variable cost. It fluctuates based on how much your output is. A fixed cost won't change. A fixed cost might be like rent, okay? Whether you're making nothing, 10,000 units, 100,000 units, your rent will stay the same, okay? So those two behaviors are usually captured separately. Now for the first time, let's think back on my previous lecture. We're going to look at the parallel view, as I call it, or a twofold view. Double vision, if you're into the song by, who did that? Foreigner, I think. Okay, double vision. We have to look at it from an income statement or GAAP point of view, and at the same time, we have to look at it from a cash flow point of view, because GAAP income and cash flow in the wonderful world of accounting are not the same. Okay? We could wait, when we did actual accounting, we could wait and do the cash flow at the end. Here, as we develop a budget, we have to look at the cash flow as we go. So that twofold perspective, we're going to see it now in overhead for the first time. I've run out of time for this lecture, so at this point I'm going to have to shut us down and resume with video number 3. Stay tuned, friends, more to come.